Hello, friends. Good morning to all of you. And today we are going to start with the new chapter, that is chapter number 11 from the module B of the ABFM. And that's about the adjustment of risk and uncertainty in capital budgeting decisions. Like how we can be adjusting the risk and uncertainty when we are going for the capital budgeting decisions. So do confirm the audio video quality at the earliest so that we can proceed. And further, from tomorrow onwards, the live classes will be on the application only. So I request you all to download the application, that is iibf.info/app, right? That's the link. And further, for the iOS user, you have to enter the ORG code, which is GEGKT, so that you can access the classes, the live classes from tomorrow onwards on the application. So let's start the session here. It's about the chapter number 11, adjustment of risk and uncertainty in the capital budgeting decisions. The first thing, it's about the sources and perspectives of risk. Now, what is actually the risk analysis is? When we're talking about the risk analysis, it's like we are to identify the risk. Analyze means we are to identify the risk, we are to measure this. So first thing that we're going to identify, then we are to quantify, that we are going to measure the risk, then we'll be evaluating the impact, and further we will be taking the measures so as to mitigate the risk or so as to reduce the risk. And it is going to help the business, investor, the banks so as to understand the uncertainty and the possible losses. So those could be understood. And if we look at the risk perspectives, that can be quantitative or that can be qualitative. So the first one, it's about the quantitative risk analysis. The first thing, it's about the quantitative risk analysis. Quantitative means we are going to use the numerical data. We are going to use the mathematical models. We are going to use the statistical techniques or simulations so as to measure the risk quantitatively. So in that case, we'll be having an objective approach. We'll be having a numerical output, like we'll be knowing that the impact will be on 200 crores. This will be impacting 150 crore or something. So we'll be having an impact value and it will be probability based. The quantitative risk approach is probability based, right? And if we look at the qualitative approach, it's basically when we're looking at the qualitative approach, like it's like we are going to do the analysis based upon the human judgment, or let's say on based upon the observation or expert opinion. That's a qualitative risk analysis. That's a qualitative risk analysis. So that's basically based upon the subjective judgment, based upon the experience, based upon the expert opinion or observation. So it's a subjective approach. It's experience based. It's basically descriptive. And further, there is no heavy mathematics. Like we can be using the interviews or SWOT analysis or ranking for that particular purpose. Okay. Now let's have a look at the types of risk analysis. The types of risk analysis. The first one, it's about the risk benefit analysis. Now, like we are going to compare the expected benefits with the associated risks. We are going to compare the expected benefits with the associated risk, right? That is what we are going to do. That is what we are going to do, right? That's the first part. Getting this point? So first thing, it's about the risk benefit analysis, that we are going to compare the expected benefits with the associated risk, and we want to determine like the benefits outweighs the risk or not. So the benefits could be like the higher customer base is there, or the more transactions are there, or lower operating cost is there. And the risk could be like, it could be like data breach or technology failure or something. So if the benefits exceed the risk, then we are going to accept the particular project. Otherwise not. The second thing, it's about the needs assessment. Needs assessment. Like we are going to analyze the current conditions of the company so as to identify the particular gap, the problem, or the deficiency, if any, right? So the need assessment is related to what? That we have to identify the gap or the problems. So company will be undergoing the need assessment so as to understand the gap that is already known. So what is missing? We want to understand that particular part. And the third one, it's about the BIA. That's a business impact analysis. Now that is going to study that how a particular potential risk can be affecting the business operation. Like if this risk happens, then how is it's going to impact the operations? That is we want to estimate. And further, the main purpose is we want to estimate the operational impact, financial impact, reputational impact, or the continuity impact, right? That's a BIA. That's a business impact analysis. Then it is a RCA. That is a root cause analysis. RCA. Like the root cause analysis is basically going to identify the actual problem, actual cause of problem. Like we are not just going to treat the symptoms. We are going to actually find the cause of problem. That is a root cause analysis. And the main purpose is what? We want to eliminate the source of issue permanently. That's the main purpose of root cause analysis, right? So these are the types of risk analysis. The first one, it's about what? The first one, it's about the quantitative risk analysis. Like we are to use a numerical data or the mathematical model or the statistical techniques in that, right? The second one, it's about the quantitative, basically risk analysis we talked about, like where we are going to use the human judgment, experience, etc. And further, it's about the risk analysis methods. So the first one, it was about the risk benefit analysis, where the risk benefit analysis, we did check, we compared the expected benefit with the associated risk. That was the risk benefit. Like what is the risk we are getting, what is the benefit we are getting, and if the benefits exceed the risk, then we are going to accept the particular project. And then we were to look at the assessment, like what is the need, what was the basically missing, why we need this particular thing, right? What is the requirement, what is the deficiency, we have to look into it. And further, the third one, it's about the business impact analysis. Like we are going to study that how a risk or event is going to impact the business operations, how much it is going to impact financially or operationally or reputation wise, right? And then the fourth one, it's about the root cause analysis. Like we are to identify the underlying cause of problem, the actual cause of problem, right? That was about it. And how to perform the risk analysis, how to basically perform a risk analysis, how it can be done. So the first thing or the first step, it's about that we are to identify the risks. We have to identify the risk. We have to prepare a list of the potential risks, and the risk could be internal or the risk could be external. So these could be internal risk or these could be the external risk. And the internal risk, like that, like there is employee fraud or system failure is there, or external risk could be like it's related to the political instability or economic slowdown is there. And we can be using the SWOT analysis for the same. The SWOT analysis, like strengths, weaknesses, opportunities, and threats. Those could be looked into. The second step, it's related to we are to identify the uncertainty. We are to understand the problematic areas, right? We are to determine the range of possible outcomes, the probability variations. We are to identify the uncertainty. That's the second step. And the third step, it's related to we are to estimate the impact. Like we have to measure the financial effect of the risk. We have to measure the financial impact of the risk. And for that particular purpose, we are to calculate the risk value. We are to calculate the risk value. So we have to look into the probability of an event, like that. What is the probability of event that can be happening? So what is the risk value basically? If we look at the impact, we can be calculating it. We can be calculating the risk value. What it is a probability of event multiplied by the cost of event, right? So let's say if the probability of fraud is 10% and the expected loss is 20 lakh rupees, then the risk value will be 0.10 into 20 lakh, right? So this is how we can be calculating the estimate impact. And the fourth one, it's about the business build analysis model. We are to build the analysis model, we have to prepare the model so as to evaluate the outcome, so as to evaluate the probabilities, so as to evaluate the financial projections. So outcomes, probabilities, the financial projections, what may occur, we have to basically prepare the model for the same. Like we can be having the sensitivity analysis or scenario analysis, or the simulation models can be there, right? And the fifth step, it's related to the analyze the results. It's related to analyze the results that the management is going to compare the probability, the financial outcome, the alternative outcomes, right, before the decision making. So it's about the analyze the results. So that is going to be played by the management part. The management is going to analyze the particular part, right? And that's basically going to take the information and going to determine the best course of action. Like they are going to compare the financial impact, the probability, and the alternative outcomes. And the sixth step, it's related to implementing the solutions. Implementing the solutions. Like we have to execute the risk mitigation plan, like so as to get the insurance coverage or diversification or the internal controls. So it's time to put a plan in action. So these are the 6 steps related to performing a risk analysis. So the first step, it was related to that we are to identify the risks. The first step, it's related to we have to identify the risk. The risk could be internal or those could be external, and we have to use a SWOT analysis. And then we are to identify the uncertainty, like we are to look at the problematic areas, we are to determine the probability variation, right? And then we are to estimate the impact, and the impact estimate can be done like we are to calculate the risk value, we are to measure the financial effect of the risk. And further, the fourth one, it's about we are to build analysis model. We have to prepare the model so that we can evaluate the outcome, the probabilities, the financial projections, and that is to be done by the management. That is to be done by the management. And further, the next part is also by the management, that is the analysis of the results, and management will be doing that. Management will be doing that, the financial impact, the alternative outcomes, the management will be looking into it. And then we are to implement the solutions, the last and the sixth step. The last and the sixth step. So if we basically draw a pointer related to it, like related to the risk analysis, RA, we can say the first one, it's about identify, because it's important. That's why I'm repeating it, right? First of all, we have to identify. And the step two, it's related to we are to look into the uncertainty, identification of the uncertainty. That is important. And the impact is to be estimated. That's the third step. And further, the fourth one, it's related to we are to build a analysis model. So we are to build an analysis model, that is to be done. The fifth one, it's related to the analysis result. So whatsoever the analysis model is built, the result is to be analyzed by the management. And the sixth one is basically so as to implement the solutions. That's the sixth step. Okay. Now after that, it's about the sensitivity analysis. Now sensitivity analysis is like, let's say we are having the multiple parameters. We are having the multiple parameters, and we have to look like if we going to alter this particular parameter, and the other parameters are going to remain all constant. These all greens are constant ones. Only the red one is variable, right? What is going to be the impact on the project outcome? That is basically the sensitivity analysis. This is a sensitivity analysis. So the main purpose is that we want to identify the most sensitive variable. So the purpose is we want to identify the most sensitive parameter or the variable, right? That's the main purpose related to it. So the important assumption in case of the sensitivity analysis is like only one variable is changing at a time and the other variables do remain constant, right? And the variables which are basically commonly tested, those are like investment cost or sales or variable cost, fixed cost, etc., etc. Those are basically looked into. So we are having an example over here that basically gives an important details of a manufacturing project. And for year 0, the investment is given to be 40,000. And for year 1 to 10, we are provided with the sales, variable cost, fixed cost, depreciation, profit before tax, tax, profit after tax, cash flow operations, and further the net cash flows. Those all are given. So the PAT is basically 4 lakhs, resulting into net cash flow from the operations of 8,000 lakhs. Considering discounting rate 12%, the project term is 10 years, the net present value is 5,200 lakhs. This is a normal scenario without getting the into the risk arising out of the uncertainty. Okay, so this is a normal scenario. So the investment made is given, NPV is given, right? And further, like we can be having the different approaches. The first one, it's like if we are having some pessimistic approach. So the first thing, it's like that we have the cash flow of 40,000. That's why the negative sign is there. The negative sign is there. Let me just make it somewhat large so that you can be looking into it, right? So it's a negative sign here. 40,000 means the initial investment. And further, these are the cash inflows. These are the cash inflows. So this is plus signs. For the next 10 years, we are getting 8,000 rupees, right? And further, the discount rate is going to be 0.12. That's 12%. And we discounted these values for first year, second year, third year, and fourth, fifth, and up to 10th. How the discounting is being done? What is the discounting formula? What is a discounting rate formula? It is 1 divided by 1 plus r raised to power n. So for the first year, it will be equal to 1 divided by 1.12 raised to power 1. For the second year, it will be 1 divided by 1.12 raised to power 2 and so on, right? So this will be like this. So we are just multiplying these terms and we are getting this particular value that's given over here. And when we basically calculated the net present value, we got it to be 5202. We got it to be 5202. Now, as per the particular NPV, if you remember, as per the net present value, like if NPV is positive, we are to accept the particular project. We are to accept that particular project, right? Now, we will be looking into one particular parameter now. We'll be looking into one particular parameter now, like if one parameter is changing, how it's going to impact that particular thing, right? That we basically need to look into. So here is the variables. Here are the different variables. Like this is going us the table below is showing us the worst scenario, the pessimistic approach, the optimistic approach, the expected approach, right? So this is the expected approach that we were looking into. This was the expected approach. This was the expected approach that we looked into and basically expected that will be having the NPV of this much and everything is basically we calculated so far, right? And there could be a pessimistic approach also. There could be a pessimistic approach also. Like in pessimistic scenario, we are thinking like that we thought that the initial investment will be 40,000, but now it raised to 48,000. We thought that the initial investment will be 40,000, right? But now it is 48,000. It's just like that the particular investment increased, but the profits reduced or the sales reduced, right? So investment increased in pessimistic approach, the sales reduced, the variable cost increased, the fixed cost increased. That's a pessimistic approach, right? And under the optimistic approach, like everything is favorable, like the initial investment reduced, like the sales increased, variable cost reduced, the fixed cost reduced, right? That's a optimistic approach. So definitely in under the optimistic approach, you everything is favorable, your NPV will be much more positive. And when it is pessimistic, everything is like reduced, so it's like negative, right? So that's the case. But the point is that it's a limitation related to the scenario analysis. Like in this particular method, only one variable is changed at that particular time. Like it's not like that we are considering every single key variable to be changed simultaneously. Because I told you in the very starting of the scenario analysis that we do in the scenario analysis, we do consider only one parameter is changing and the others are kept constant. So when the investment is 48,000, we are keeping the sales, variable cost, etc. everything at the same point, everything at the same level, right? So when we are changing the sales, we are keeping other things constant. right? So this is how we are working, and we calculated these values, and we basically calculated these values in that particular manner, right? So that's basically the scenario analysis. That's the limitation that we learned about, right? Clear with it? Now, what were the steps which were involved in the particular analysis? What were the steps in sensitivity analysis? So first of all, we are to identify the variables which are affecting the value of IRR and NPV. We are to identify those factors. The second thing, we are to develop a mathematical understanding of those factors. Like we are to understand the mathematical relationships. The third thing it's related to, we are to measure the impact of changes in variables. We are to measure the impact of changes in each of the variables, that how it is going to impact the NPV or the IRR. Clear with it? Right? So that was basically the point related. You can also be looking into this particular example. Let's have a look at this example also. So it says like ABC Limited, the new project, the following details are given: the initial cost, the annual unit cost, sales, variable cost, fixed cost, discount rate, these are given. And further, consider life of the project as 3 years. We have to calculate the NPV of the project, assuming the tax rate is 0. We have to compute the impact on the project's NPV considering 2.5% adverse variance for each variable. Which variable shall have the maximum effect? Right? So the point is that we are considering the negative variance for each of the variables. Negative variance, like the initial capital cost will increase by 2.5% in one case. In another case, the annual unit sales will be reduced by 2.5%. The selling price per unit will be reduced. The variable cost per unit will increase. The fixed cost per unit will increase. The discount rate will increase. So we are to basically use the adverse factors for each of the things. Then we have to answer that which particular factor or variable is going to make the most negative impact. That's the exercise. That's a particular exercise being done. Let's just, this is a sensitivity analysis over being done over here. So you can be looking into it. So you can be looking into it, like for one case, we are changing the selling price. For one case, we are changing the variable cost, contribution, etc., etc. And then we are calculating the values, that what is the impact over the value, over here. And based upon that, we are calculating the net present values of the same and looking at the percentage change in the NPV. Like in one case, NPV is 134.60, in another 124, 101, 117, 131. So this is a worst scenario. This is a worst vector variable scenario, and this is related to selling price of the unit is reduced. When the selling price of the unit is reduced by 2.5%, it is making the worst scenario. So this is for the understanding purpose only. I just wanted you to understand that these things can happen this way, that these things can happen this way, right? Clear with it? Now, let's move further toward the scenario analysis. One, it was the sensitivity analysis, and now it's about the scenario analysis. Now, what is scenario analysis? Scenario analysis, like when we'll be having the complete scenario change. Like in one scenario, we are thinking like everything is uh, same, and the other scenario, we are changing the multiple parameters, because that was the limitation of the sensitivity analysis, that in case of the sensitivity analysis, we were changing only one parameter. But in case of the sensitivity analysis, in case of the scenario analysis, we can be changing the multiple parameters also. So multiple combined situations or scenarios could be there. And further, we look at the three particular scenarios. Those could be like the pessimistic, the worst case scenario, expected or normal, like the most likely case, and optimistic, that is the best one. So the expected one is basically the normal scenario. The pessimistic is like, optimistic is like the best scenario, and the pessimistic is like the worst scenario, right? These are the three different scenarios. Now in scenario analysis, all variables do move together simultaneously, like I just told you. So all variables just move together. So it's not like that only one parameter is changing and other are kept constant. That's not the case, right? So here is a scenario. One, it is considered with a pessimistic, expected, and optimistic. So when you are having the pessimistic scenario, your NPV is negative, huge negative, right? And when it is Like most likely it is 50 to 100 positive, and when it is the best one, it is very positive. In that scenario, it is very positive. Getting the idea? So that's basically about it. So one case you're getting the negative NPV, that's the worst scenario. So basically we change all the parameters. In this case, in this particular scenario, we all change all the parameters. Whereas in the case of the sensitivity analysis, we just change the one parameter, keeping the others constant, and then we have to calculate for each one, right? But in scenario analysis, this is not the case. Either we are taking the very worst scenario, adverse scenario, where all the parameters are adversely affected, right? That's a pessimistic scenario, or it is basically the best for ourselves, right? So like the investment decreased, initial investment decreased, the sales increased, and those all are working simultaneously. Those all are working simultaneously, right? That's the case. So for the sensitivity analysis, if we look at, let me just tell you about the sensitivity analysis, and the other one, it is basically for the scenario analysis, right? So in case of the sensitivity analysis, if we look at the variable change, right? Only one variable was changing at a time. But in case of the scenario analysis, all the variables were changing at the time. And if we look at the complexity, which one will be more complex? Definitely the sensitive one is simple. It's simple. And the scenario analysis is basically complex. It's basically more realistic, we can also say, right? That's the case. So this is more realistic. This is lesser realistic. And further, in this case, our focus is on individual variables, individual variable impact. And in this case, we are having the overall variable impact. Okay. Clear so far? Do confirm if I've understood the topic so far, so that we can proceed further. The next model is Hillier model. It's the Hillier model. So we'll be moving ahead if you have understood the topic so far. Okay. So it's about the Hillier model. Now, Hillier model is actually what? It's a risk analysis technique. When we're talking about the Hillier model, it is what? It is the risk analysis technique. And this is used in capital budgeting. This method is basically used in the capital budgeting so as to evaluate the project viability, right? So basically this is used for the determining the viability of the project, and this is the risk analysis technique. And we do measure the variability. What we do measure? We do measure the variability in cash flows. We do measure the variability in cash flows, right? Second thing, we do measure the risk associated with the NPV. We do measure the risk associated with the NPV, right? So that we do basically measure in case of the Hillier model. It's a, just look at the important points. First one, it's a risk analysis technique, right? Second thing, we do determine the viability of the project. Okay. And we basically measure the variability in the cash flows and further the risk associated with the NPV. And it focuses upon what? It focuses upon the expected NPV. We do focus upon the expected net present value and further the deviation from the standard NPV, the standard deviation from the NPV that we look into. So we can simply be saying that if the deviation is more, let's say we are calculating the NPV and we are calculating the expected NPV. We are calculating the expected NPV and the deviation we look into, the standard deviation we calculate for the same. And if the standard deviation is more, If the standard deviation is more, then the risk associated, the project risk, we can say, the project risk will be more, right? That is basically the Hillier models. Okay. So this basically model calculates the expected NPV and further the standard deviation of the NPV. That's it. And there are two cases in case of the Hillier model. There are two cases in case of the Hillier model. The one case, it's related to the uncorrelated cash flows. The one, it is related to the uncorrelated cash flows, like cash flows of different years are independent. What it says? It says the cash flows of different years are independent. They are not dependent upon each other, right? And further, the second one, it's about the correlated cash flows. Correlated cash flows. Like the cash flows are moving together in the same direction. Like if the year one cash flows increases, then all future cash flows will also be increasing proportionately. That is basically the correlated cash flows. And uncorrelated cash flow means that the cash flows of first year, second year, let's say the project life is of 3 years, then the cash flow of first year, second year, third year, those will be independent. They're not dependent upon each other. But the correlated says the cash flows of 1 year, 2 year, 3 years are there, and the cash flows for the first year, if they do increase, then the second year will also increase, the third year will also be increased, and also proportionately. That's basically the correlated cash flows. In case of the uncorrelated cash flows, the formula for the expected NPV bar, that is expected NPV, that is basically CT bar divided by 1 plus I raised to power T minus I. The simple formula as we basically read about. The simple formula that we read about. That's basically the NPV bar formula. Right? And further, for the standard deviation of the NPV, for this standard deviation of the NPV, the formula is sigma t square divided by 1 plus I raised to power 2t and under root of the same. That's the formula for the standard deviation of the NPV for the uncorrelated cash flows. And now the point is, because the variances, because the cash flows are independent, like I just told you, the cash flows are independent. That's why the variance for each of the cash flows are added up. The variances are added up and square root is taken finally. Like the square root over here, let me just be much more clear to you right here. Like for this particular case, the square root will be on this complete term. It will be on the complete term, right? And this generally produces lower total risk because the diversification is there. Getting the point? And if we look at the perfectly correlated cash flows, the formula is basically for the particular NPV, it's all same, right? Expected NPV formula is all same, but formula for standard deviation, that will change. The formula changes over here. Like it is sigma t divided by 1 plus I raised to power t. And further, the under root is not there, right? So the overall risk basically becomes higher because the diversification benefit is not available in case of this particular case. So for this Hillier model, it's basically the risk analysis technique, which is used to check the viability of the particular project. We do calculate the variability in the cash flows and the risk associated with the NPV. And further, we do check the deviations between the NPV to the expected NPV. And more is the deviation, standard deviation, more will be the project risk. And we do consider two cases. One, it is related to the cash flow, unrelated cash flows. Like in that scenario, we are having the overall under root, right? So the benefit of diversification is available and the low risk will be there. And in case of the correlated cash flows, like the benefit of diversification is not there and the higher risk is there. And what is CT? CT is the expected cash flow in the year T, right? And sigma T is standard deviation of the cash flow in the year T. And I is basically the risk-free rate and capital I is the initial investment. That's it. Clear with it? Then after that, it's about the simulation analysis. The next, it's about the simulation analysis. So simulation analysis is basically going to create what? It's going to create the artificial situations. Simulation, they're like you're simulating the airplane. So you're basically not flying the actual plane, but you are like doing it on computer artificially. So it's like it's going to generate the artificial situations. We are going to generate the artificial situations to study the project risk under the different conditions, right? So we'll be generating the possible outcomes, artificial but possible outcomes, possible situations. And for those situations, we are to calculate the NPV, we are to calculate the IRR, we are to basically calculate the probability of success or failure, right? So we'll be creating similar but artificial situations. And further, firstly, we have to conduct the situations, and then we have to look at the NPV, IRR, and other criterions. Okay. So what is the main purpose of simulation? Why do we find out the simulations? Because we are to handle the uncertainty. We want to basically study the multiple variables simultaneously, and that's possible through the simulation zone. Now let's have a look at the steps involved. Let's just have a look at the steps involved. First of all, we have to prepare the model project report. The first thing that we need to do, that's prepare the model project report. Like, so that we can estimate the investment or revenue or cost or cash flow, right? We have to estimate these things. We have to prepare the model project report, that what will be the investment, what will be the revenue, what will be the cost, what will be the cash flow, and everything, right? And then we have to calculate the NPV and IRR based upon it. That's the first step. The second step, it's related to, we have to identify the relationship of the variables, that how these parameters are related, how these parameters are related. We have to identify the relationships, and also at the same time, we have to identify the exogenous variables. We have to identify the parameters. We are to identify the parameters and the exogenous variables. Like the parameters are basically which are controlled by decision makers. These are the things which are controlled by the decision maker. And exogenous variables are those variables which are outside the control. These are outside the control, right? Like the inflation, government policy, etc., etc., right? So parameters are the input variables which are specified by the decision maker, right? And exogenous variables are basically outside the model, and those are imposed on the model, and those are not in the control of the decision maker, right? And now we are to assign the probability distribution. Like, we do basically estimate the probability distribution of the exogenous variables, and further we'll be giving the fixed values for the parameters. And further, the random value selection is to be done. Like, random values selected from the probability distributions. From the probability distribution of each of the exogenous variables, we have to select a random variable, random value. And further, based upon that, we have to calculate the NPV, the net present value. We'll be computing the NPV using the randomly generated values. And further, we'll be repeating it time over time. Then we'll be plotting the frequency distribution. Like which particular simulation is most probable or suitable, we'll be looking into it. So these are the 8 steps which are involved. These are the 8 steps which are involved. Let me just record this step to you. First step, it's related to, we have to prepare the project model report. We have to estimate the cost, the cash flows, and everything. Then we'll be calculating the NPV and IRR. The second thing, we are to basically establish the relationship between the variables, like which variables are affecting Like we have to determine that how the NPV is changing with the sales, cost, demand, etc. Then we have to determine the parameters and exogenous variables. So parameters are the input values, and further the exogenous variables are those variables which are not under the control of the management, right? And we are to assign the probability distributions to them. We are to estimate the probability of different sales level, cost changes, demand fluctuations, etc. We'll be looking into that particular thing. So the third step was related to we are to find out these variables, and further the fourth step is related to we are to fix the value of the parameters, and we are to uh, like estimate the probability distribution for the exogenous variables, right? And we are to do the random selection of these probability distribution that is to be done, and based on that we will be calculating the NPV. We'll be calculating the NPV like for the randomly generated values, and we have to repeat it many times. We have to repeat it many times. So that's going to be the seventh step. And further the eighth step, it's related to the plot frequency distribution. Like we have to analyze the most probable outcome. We have to analyze the probability of loss, the probability of profit, right? So that's to be taken care of. So what is the advantage? Like very much realistic. We can be handling the uncertainties, and it is very much useful for the large projects. But this method is very complex. Like if we look at the limitations, this is a complex one, not an easier one, not the easier task, and also very time consuming, right? And it depends upon the assumptions. After that, it's about the decision tree analysis. The next one, it's about the decision tree analysis. Like decision tree analysis is a graphical technique. It's a graphical representation. It's a graphical technique. And further, it is going to showcase us the decisions. This technique is going to showcase us the decisions, the possible outcomes, right? The probabilities, and further the rewards or losses, right? So decision tree analysis is a graphical technique which will be showing us these four things. One, it is decisions, the possible outcomes, the probabilities, and reward or losses. And there are the different elements of the decision tree, the different elements. The first element, it's a branch. Branch is basically representing the alternative course of action. It is representing the alternative course of action that this can be done, right? And further, the second element, it's the node. Node. The node is representing what? The node is representing the outcome. It is representing the outcome or the reward. Like it is a probability attached to the reward. It's the outcome or reward. It's basically showcasing you the probability attached to the reward, right? So that's basically what that's the node. So here is an example related to it. So branch is showcasing you basically a decision that you're going to take. It's basically representing a decision or the alternative course of action, right? If you basically take a decision, then you will be reaching out this, right? And for the node is basically representing the reward that you'll be getting or the probability attached to that particular outcome. Let's just have a look at this particular example. So finance manager has to select either project A or the project B. The reward of the project A NPV is 5 lakh rupees and the probability attached is 40%. The reward of project B is basically NPV 4 lakh rupees and the probability attached is 40%, right? So this is given. So decision tree visually is going to compare the risk, reward, and probability. So there are three things that we will be taking care of. That's basically the first thing is risk. The second thing is reward, and the third thing is the probability, right? These three things we have to look into: risk, reward, and probability. Okay, so that is to be taken care of. Now the decision tree can further grow. Like let's say if there are There can be more branches from the node itself, from the node of the first, or let's say the second branch, if there are any further uncertainties associated with the same. So basically that will be represented by a branch. That will be a branch. So what about this particular thing? Like we are having the project A and project B, and here the NPV is 5 lakh, here the NPV is 4 lakh, here the probability is 40%, here also the probability is 40%, right? And we are to basically get the expected value, that is said to be the EMV. And what is EMV? EMV is probability into payoff. That is probability into payoff. Now for the project A, the EMV would be equal to 0.40 into 5 lakh. That is 2 lakh rupees. The EMV, expected monetary value, it will be 2 lakh for the project A. And for the project B, it will be 0.4 into 4, that is 1.6 lakh. Now for which the EMV is higher, the project A's EMV is higher, so the project A is preferable. Project A is preferable, right? And as I told you, the further the tree can be growing, the decision tree can be further be growing. Like further branches may emerge, like if additional uncertainties do exist, right? So that can be the case. So the graphical representation will be through two or more branches. Graphical representation will be through two or more branches in that scenario. Getting the idea here? Are you clear with the EMV concept so far? So just try to understand one particular part. Like we are to understand this particular concept, first of all. Like suppose management initially selects the project A. We are having the multiple projects and the management selected the project A. Now, after we have selected the project A, there might be the another options that we are getting. Like option one is like that we can be executing the project internally, or the option B could be related that it's a turnkey contract, that we can be going for the turnkey contract. So there's a new two branches are going to emerge from the project A node. So itself, it was a node. Like if we are having multiple projects like A, B, C, these are the nodes A, B, C. And further, these were the branches that what decision is to be taken. So the decisions are represented by the branches, right? The alternative course of actions which are available to you. And what was about the node? Decision that you know that what was about the node is basically the end of the branch which is going to showcase you the reward. And further after this, if we selected the project A, we are having the further options that we can be like it can be internal project, we can be executed internally, or it could be a turnkey project, right? So that's about it. So each branch may further be having the different cost. Each branch can be having the different profits, different probabilities, right? So that's a part related to it. That's a part related to it. And further, why the decision tree grows? Because real life projects do involve multiple uncertainties. And what is the role of management in that? Like management is to decide that what factors are important, that whether we are to execute it internally or it's a turnkey project, that the management is basically looking into it now. So the management has to decide the factors like the project size, the decisions may be depending on the project size, the complexity, the risk level, right? So that's the point. And the two main steps in decision tree analysis are there. There are two main processes. One thing it's related to delineating the decision tree. The step one is basically said to be the delineating the decision tree, right? that we have to graphically represent the decisions, the alternatives, the outcomes, the cash flows. This is a drawing of the tree, decision tree, graphically representing the same. This is called drawing the tree or delineating the tree. And what is the objective of drawing? That we want to visually understand the sequence of decisions, the possible future outcomes, right? That's the main thing. So we can be using the square node like that, which is showcasing a decision point, or circular node like a probability event, and the branch, which is basically showcasing the alternative course of action. And the second step is related to evaluating the outcome. This is the step number 2. That is evaluating the outcome. And the evaluation is going to start from the last branch toward the starting point. So when we basically, first of all, we have to draw a tree, decision tree. Let's say this is related to decision tree. Right. And further, it could be having a many number of branches or options, like it could be like drawn into multiple parts. And when we have to evaluate, the evaluation will be starting from the last branch toward the starting point. Let's say we selected the project B, so it will be starting from the last branch that we selected toward the starting point. And why backward evaluation? Because the final outcomes known at the end branch. The final outcome will be coming over there. The final outcome is known at the end branch. So expected values are calculated backward, like the best path selected step by step. Right? So that's the case. After that, it's about the corporate risk analysis. The next topic, it's about the corporate risk analysis. Now, what is corporate risk analysis? Any idea? Like it means that we have to evaluate at how a new project or investment or business decision is going to impact the overall risk profile of the company. That's a corporate risk analysis. Like let's say if you're going to make a new, if you're going to undertake a new project or new investment, or let's say new business decision is to be taken, how it is going to add up to the overall risk profile of the company. Like we are going to study the combined impact of the company. We are going to evaluate the combined impact of the company, right? Overall financial stability is to be looked into. And what are the main objectives of the corporate risk analysis? Like we want to protect the company from the excessive risk first of all. We have to reduce the overall risk. We want to protect the company from the excessive risk. We are to maintain the profitability. We are to maintain the profitability, right? And further, what are the types of risks which are faced by the corporates? It could be the economic risk, right? It could be the economic risk. It could be the competition risk, financial risk, reputation risk. Many risks are faced by the company. Many risks are faced by the company. And the main point is related to that we are to manage the risk. So the risk management basically does require the specific skills that we are to identify the risk, we are to assess the risk, we are to control the risk. That's the risk management. That's a complete risk management. And it starts with identifying. Like first of all, the process is related to we are to identify the risk. Then we are to quantify the risk. We are to measure the amount of risk in monetary terms, quantifying it. Then we basically try to control it, and the mitigation part, right? So this process is to be followed. So we do require the technical expertise, the business knowledge must be there, in-depth business knowledge is to be there, the strategic planning is to be looked into, the monitoring ability is required. And what are the types of risks? It could be the internal risk, it could be the external risk, right? So multiple types of risks are there. And further, the factors or sources of risk perception. the factors or sources of risk perception. The first factor is the cost. So cost is the biggest sources of risk. Like we can be having the fixed cost or the variable cost. Fixed cost like that do not change with the production level, plant, building technology, permanent staff salaries. That's a fixed cost. And there is a risk of high fixed cost. Like if the fixed cost is higher, then even if the sales are declining, those are to be constant. And there is a big risk related to it. There is a big risk of high fixed cost, right? And that is going to increase what? That is going to increase the operating leverage risk. So if the fixed cost is higher, that is going to increase the operating leverage risk. That will be increased. And when we are talking about the variable cost, it is a cost which is changing with production. Like if you're producing 10,000 units, your variable cost is basically for that purpose. If it is 50,000, then the variable cost will increase proportionately, like for the raw material, power, packaging, etc. Right? That's a factor. That's a one factor, right? And then the another one is related to the financial leverage. It's about the financial leverage. Like we may be using the borrowed funds in the capital structure. Like the debt is a part of the capital structure. Now we are either using the equity or the equity or the debt. So debt is a part of the capital structure. So it may be the case that like we have taken a we can be buying a product of our own. We can be buying a particular asset of our own, or let's say we are taking it on lease, right? So there are, even if we look at the equity, it may look cheap or free, but there is high cost of equity. There is risk of high equity. First of all, if you're having higher equity, like there is dilution of the ownership and there is loss of the promoter control. And if you're having high debt, then definitely it will increase your DER. Your overall DER will increase. Debt equity ratio will increase and means more risk will be there. And further, your profitability will reduce because if you're having higher debt, then you have to pay a part toward the servicing of the debt also, right? Your financial burden will increase, right? So the multiple things are to be taken care of for equity as well as for the debt. Both can be imposing the risk. There should be a proper mix of it. Like if any of the component increases, definitely the overall risk will improve. The overall risk will increase, not improve, right? The third factor, it's about the pricing. The first factor was the cost. That's the biggest factor of the risk. The second, it's a financial leverage. And the third one, it's about the pricing. Like pricing risk is what? That risk arises from the product pricing decisions. Product pricing decisions. Now, there can be the internal factors and the external factors. There can be the internal factors and external factors. Internal factors like cost structure, production efficiency. Now, if your production efficiency is low, you are to price it higher. And further, if the particular competitor is pricing the product low and you are competing and basically you are pricing it higher, then definitely it's a problem. So company may not be affording the low pricing, but market competition forces the prices reduction, right? It may be the case that the product is costing you rupees 9 and further you are want to maintain a margin of rupee 4 so as to sell it at rupees 13, but your competitor is selling at rupees 11. How can you be selling at rupees 13 then? Right? Not possible. So one has to be very much skillful and accurately calculative so that we can be calculating the break-even point. We have to do the break-even analysis, right? And after that, we want to basically decide at what minimum sales are needed so as to avoid the loss. And then we have to work upon the price, right? Further, the fourth one, it's about the sequential investment. Sequential investment. Now, what is sequential investment? Like the additional investments that is to be made step by step based on the business growth and the market trends. That's the sequential investment is. No, definitely there is risk. Like you can be doing the over spending, like over expansion if be done. Like or if we have invested excessively, or we basically misjudge the market demand, there is a risk associated with the same. And the fifth one, it's about the information intelligence, like proper market research and information gathering before taking the decision. Now, the point is that if you jump started without market study, without technical analysis, without the competitor analysis, without the feasibility, definitely it will be a huge loss to you. The sixth factor, it's related to the strategic alliance, like partnership or collaboration with the other firms. Now, in that case, you can share the risk, you can share the resources, you can enter the new markets, right? That could be the case, and that basically giving an opportunity. At the same time, it's giving an opportunity, but before the same, you have to plan like what strengths will be available to you, and basically you have to draft a memorandum of undertaking, like that can be helping users to understand, right? And further, the seventh one, it's about the insurance, like transfer of risk to the insurance company. So you can be getting yourself insured against the fire, flood, earthquake, right, war, etc. The eighth one, it's about the supply chain management, SCM. So we have to manage the procurement and supply network efficiently. That's the supply chain management. So it's going to reduce the uncertainty. If you're managing it properly, it's going to reduce uncertainty. You can be controlling the costs, right? And further, it is important for those particular commodities where the price fluctuations are very wide, where the markets are volatile, right? That's the part. And further, the ninth one, it's about the derivatives, like the financial instruments which are used for the hedging purposes. So you can be protecting yourself, you can be safeguarding yourself against the price risk, against the interest rate risk, etc., etc. And further, the 10th one, it's about the shorter time to market, like launching the product quickly after the innovation. Quickly after the innovation, we have to launch the product. So the first mover advantage will be available with you. And further, you can be, otherwise, if you don't do that, your competitors may be capturing the market, or they can be introducing the substitute product. And the 11th one, it's about the contingency planning, like the preparation of the backup action plan for the adverse situations. Preparation of the backup action plan for the adverse situation, so that we can be handling the emergencies, right? The cyber attack, the any disruption if there is any. So that's the main point related to it. And these are the 11 main points related to it. So let's have a look at the first point. It was about the cost. The first factor, it was about the cost. The second thing, it's about the composition of the debt and equity. The third thing, the pricing. The fourth one, the sequential investment, like the investment that we are doing after the initial investment. The information intelligence, like if you do not gather the particular information, then very huge risk. Strategic alliance is very much important. Insurance, like so as to save our guard ourselves, and supply chain management is also very much important, specifically for those commodities like which are very much, there are which are very much volatile. And then it's about the derivatives which can be helping us so as to hedge our positions or exposures, and shorter time to market, like when you innovate, you should be launching the product as soon as possible. And contingency planning, like so as to plan for those situations which are adverse situations. Okay, so that will be all related to this video. I hope that you must have understood the idea related to this video, and you must have understood all the topics so far. So do rate this video out of 10, and make sure to like this video and further share this video. And further, if you're having any doubts, do let me know. The complete CIIB crash course is available. Simply just do write CIIB and WhatsApp it to the number 83609 and I'll be sharing all the details with you. So thank you so much, and see you again in the next video.